Hello and welcome to the Wealth Doc podcast with your host, Mike Heckman. I'm Wendy McConnell. Hi, Mike. How are you feeling today?
Oh, fantastic. Good to be here, Wendy. How are you doing?
Oh, I'm doing great. Now we have a guest. It's very exciting. We have Pete Oquist today, who is going to tell us a little bit about the FDIC. Hello, Pete.
Hello, Wendy. How are you?
I'm good. Thank you so much for joining us. Now, you're a retired examiner for the FDIC?
That is correct.
All right. So we're going to learn all kinds of things today, Mike, right? Very exciting.
No, it's Pete's always a good conversation to have. He's one of my favorite people to talk to, and so excited to have him as our first guest on the Wealth Doc podcast here.
Yes.
Glad to be here.
So Pete, so when you started going to school, was the FDIC your goal, or talk a little bit about what you went to school for and what you wanted to be when you grew up?
I was totally out of my mind. I didn't even think about the FDIC. And in fact, I knew very little about the FDIC. So I was an accounting major at Michigan State, and I actually ended up in the oil patch working for an oil and gas company upon graduation. So from there, I wiggled my way through a couple of different agencies, but I've been doing this bank examining for over 30 years. I performed as examiner with the state of Michigan for 15. I worked for the Federal Reserve Bank of Chicago for 5 years and ended up with the FDIC the last 11, 12 years where I retired from.
Awesome. So what was your role with the FDIC? What was like the day-to-day for you, or did you have different tasks that you had to do?
You know, it was very interesting, and all three agencies did the same thing where it's your roles change every job, just about every week. If you're doing an assignment, you could be the person in charge of the examination. And what goes around comes around. It works pretty neat because you could be, like I said, the examiner in charge on one exam, and then the next exam, you might be working loans or one of the little grunt guys there. So what people do remember is how you worked for them when you were not in charge. So it worked very well.
Fantastic.
May I just ask the FDIC? Now we all kind of know that's the insurance agency that protects our money at banks.
Yes, that is correct. The FDIC is the only insurance agency for banks, and there's different regulators. The Federal Reserve is in charge of regulating Fed member banks, and the OCC is in charge of insuring national banks. And then the states usually have banking agencies that assist with those examinations, but the FDIC is the only agency that actually insures bank deposits.
Wow. And what are you examining then?
Well, when we supervise a bank, we do on-site examinations, usually every 18 months, depending on the size and complexity of the institution. If it's in troubled condition, we'll be in there maybe every 6 months. But normally a bank is examined on site every 18 months by a group from anywhere from 4 to up to 20 examiners. And then in between examinations, every bank is required to file quarterly call reports, which are standardized forms for their balance sheet and their profit and loss statements. And we use those as an analytical tool to evaluate their condition in between examinations.
So when you see this, were the banks required to have certain types of investments on their own balance sheets, or how does that risk play in there?
Usually a bank can have what they want to invest in. There's certain limitations. I mean, they can't go out and buy private corporate bonds or anything like that, but they can kind of decide their own mix. Ever since banks were deregulated back in the 60s, I believe.
Bankers wow.
Yeah, and it's amazing because the typical banker back in them days, they didn't have to be very intelligent to run a bank. The government told them how much they could charge on deposits, how much they could pay on loans, whatever. So
you just kind of went in and you're more of the transaction person rather than setting up any your own matrices or whatever.
Exactly. And then once deregulation happened, all of a sudden, people had to think. They had to get smart. They had to learn how to manage a bank. And
So then your entire 30-year career was after the deregulation when the bankers had to intelligently handle the risk.
that is correct.
Wow. All right. All right. Can you take us through an interesting scenario that you had to deal with during your 30-year career?
Yes, I can. There was a bank no longer in existence. It's called IndyMac Bank, and it failed back in 2008. And my supervisor got a hold of me on a Tuesday and says, Pete, I'm not supposed to tell you this, but Thursday, I'm going to get a call from the FDIC out of Dallas, which is our resolution and receivership division, who handles all the bank closings. And they're going to ask me to send you down to Dallas for 3 months. And I said,
3 months.
thanks for the heads up, Diane. So anyways, I was glad for the heads up because then I was able to go home and kind of make some preparations and everything. So
Settle your affairs.
yeah, settle my affairs, exactly. So I get to Dallas and it was pretty interesting. IndyMac Bank was just being taken over and we were in charge of dealing with the depositors. And the first thing I was told is you're working from 7 to 7. It's 12 hours a day, 7 days a week. So that's what we did. And our office was just a mess because we had 3 or 4 floors on a building downtown Dallas, and it was triangle in shaped. So we had desks all outside every one of those triangular perimeters, and we had phones just every place.
How big was your team?
It was probably over 200.
Oh, wow. 200 people working 7/12s
Yes,
for months.
It was insane to say the least.
So what was all the work? What was the reason for all the encumbrance?
Well, my job was I ran a call center. So when a bank fails, the first thing the FDIC does, it'll reach out to depositors and say, hey, Mrs. Doe, we understand you have $212,000 in the bank, and our initial determination is that, back then it was $100,000, not $250 like it is today.
So 112 of your money wasn't protected.
Exactly. And so if they weren't happy with that, then they called us. So we got the nervous
a lot of
people.
happy campers.
Yes, exactly. Happy campers. That's a good term. And a couple of those I have to share with you. There was one woman who called me from California, and she had 400,000 plus of uninsured deposits. And this woman, I talked to her for over 45 minutes. Yeah. And when I got done, she actually thanked me. And I hung up and I just said, wow, all she needed was somebody to talk to. So amazing. I was glad I was that guy.
All she needed was somebody to talk to.
Yep. And then there was another guy who was at the far end of the spectrum. He was from New York, and he called.
Geographically and personality.
Yes, just about the same. And he had $190,000 in the bank. And he called and said he didn't agree with the initial deposit determination that he was going to be out $90,000. And I said, well, let me review everything, which I did while I was on the phone. And I said, I'm sorry, Mr. X, but I agree with the initial determination. You have $90,000 uninsured deposits. And he said, why don't I effing go to DC and blow up your effing building? And hung up the phone. And I said to myself, wow, did this just happen?
Right.
So I went to my supervisor and I said to her, I said, I don't think this guy's serious, but I said, you just never know. Yeah. So I explained to her what happened, and she ran it up the flagpole, and that was the end of it. So then on my last day there in Dallas, so a couple of the higher management people came down to thank the few of us that were leaving that day. And he asked me if I ever heard the story about what happened to that gentleman from New York that called. And I said, no, I had not. And he says, well, that afternoon, 2 FBI agents knocked on his door and said, if you ever threaten a federal employee again, you're going to prison.
Wow.
I said, wow, that was pretty fast. So
that afternoon, he's got the armed FBI agents knocking on his door because he lost his temper with you.
Yes, that's exactly correct.
Wow.
Yeah.
So do you see a difference in like how the FDIC was handling the banks then? Like what year did you retire?
I retired 6 years ago,
Okay.
and I don't see a lot of difference in regulation, but what I'm surprised at, Mike, to be quite honest, is the recent bank failures that we just had. Um, I know why they failed because I'm a bank examiner and I can just look at the numbers and kind of figure it out.
Right.
But what really surprised me is the regulators really dropped the ball on all three of these banks.
The regulators dropped the ball.
Yep, I mean, it was the management's fault, but the fact that the regulators didn't step in before or like 2 years ago, say, hey, you're going down a rocky road here. We need to turn this bus around. I'm just appalled that did not happen.
Interesting. Interesting. So do you see the FDIC handling the failures differently than what you had to deal with as far as uh protecting depositors, or does that seem to be like the same way it was when you were taking care of those things?
I don't see any difference, although I know when these most recent bank failures happened, I know some people from the White House were saying that, anybody that's uninsured depositors will be made whole. And I'm trying to think to myself, how's that going to happen? Because
Yeah,
I
especially
know
that lady
one,
in California and
yes. Yeah. And
wow.
she was out 400,000. So how can she be out 400,000? And some of these other current clients, one client had $487 million parked at that bank in uninsured deposits. And the first thing I'm thinking is two things. Why didn't the bank, somebody within the bank, kind of monitor some of these uninsured depositors and see how big they were getting? And
Yeah,
then
yeah.
number
Does the
two,
bank have a responsibility to notify or educate their depositors as far as insurance protections?
they have to be prudent. And to me, that was not showing any prudence at all.
Yeah,
Um,
so prudence is a subjective term, or, or.
yeah, you're right, it's subjective, but I can't believe that went unnoticed. And then I don't know who the CFO was for that company that had the 487 million, but my goodness, talk about people being asleep at the wheel. It's just
Yeah.
unbelievable.
So when you said that you could tell like how the banks failed or what the cause was, from your own analysis of the situation, do you think that it was similar factors with these recent bank failures, or did they all make different mistakes?
I'd say they're kind of pretty reasonable, the same. For example, one of the recent bank failures, they had billions of dollars in government bonds, which you think, oh, they're being pretty prudent. They're being safe. They're buying government bonds in their investment portfolio.
Until interest rates
However,
goes up. Yeah.
right, exactly. When the Fed started raising rates to combat inflation, well, as we know, when interest rates rise, the value of the bond goes down. And so they're left with hardly anything on the dollar in these bonds. And so people start taking money out of the bank. And once that happens, you have a liquidity crisis.
So on a typical bank, as far as like you talk about liquidity, so just like what percentage do they usually keep liquid, or is that depending on the bank?
It depends on the bank because different banks are structured differently. So there's not a good answer for that question, but it depends
Okay.
on the bank.
And then how often did banks get audited or examined, to kind of make sure that they were staying I don't know what the best term is, banking right, now that they have to be intelligent
Right.
bankers.
Like I said, 18 months was our normal exam cycle. Some of the bigger banks, the JP Morgan Chase, all the huge bankers in the country, they're regulated probably annually and even quarterly visitations. And it's
So
not just one
so
agency;
so
it's
big
all of
so
them.
bigger gets more scrutiny.
Exactly.
Okay. Right on. So uh do you still have friends that are in the business with the FDIC?
Yes, I do. I stay in close contact with a lot of my coworkers, ex-coworkers.
And uh I'm trying to think of the best way to phrase it. Like, so what's the attitude? Do you think it's declined since you were in, or is it still pretty just as smooth with those only having to work 7 days a week, 12 hours a day?
No more of those, thank goodness. But I think it's pretty similar today. There's more opportunities and people are doing different things. A lot of my coworkers are moving on to different things, like they're specializing in maybe information technology examinations or trust examinations. So there's a lot of opportunities, and so it's kind of, you make it what you can. And if you're bored, it's your own fault if you work for the FDIC, because there's a lot of opportunity.
So you'd recommend it to somebody that's in school for like finance or accounting, or?
I definitely would. The only bad thing about the FDIC, as well as all regulatory agencies, is you might have to travel more than you would like to.
Right. And you raised a family while you were working.
Yes, I did. One thing that allowed that to happen smoothly is flexibility. So if my son was had a baseball game, I was anywhere near it, I would ask my boss, hey, can I take a half a day off so I can watch a baseball game? Go for it. The flexibility was awesome, and it made it all work out well.
No, so they gave you flexibility as long as you weren't knee deep in or neck deep in some kind of bank failure.
Yes, like when I was in Dallas for those 3 months, there was no person, I'll take that back in a minute, that could get me out of that examination or that position, except for my dear mother-in-law passed away at 94.
Oh no.
And we were all expecting it. It wasn't a surprise, but she was the only person that got me out of Dallas. And so I took a couple of days off and attended her funeral, and then headed back to Dallas, and I thanked her for getting me home.
Yeah. Yeah. So for that 3 months, the only couple days that you took off was to go do that mourning process.
Sure, that was it.
Wow. So go ahead.
I would say it was pretty intense.
So you've been retired now for 6 years?
Yeah, about 6 years.
So do you find yourself enjoying retirement, or how are you spending most of your free time now?
Yes, I do. I got a couple of organizations that wrote me into being the treasurer, so it keeps me busy a little bit with the numbers. So I'm not totally bored. So, and a lot of projects around at home, and I'm busy.
Okay, right on. So really appreciate you being here, Pete. And this has been an absolute fantastic talk with you. Enjoyed having you on the Wealth Doc podcast. So super appreciate your time.
Well, thank you, Mike, and thank you, Wendy. I appreciate it.
Well, we're so glad that you're here, Pete. Mike, how can people get in touch with you?
Yeah, we can check out my website at sablepointwealthmanagement.com, spelled SABLE, like sablepointwealthmanagement.com. Or my team is happy to assist on the phone at 231-425-4308. Again, 231-425-4308.
And thank you for joining us today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.